With the depletion of foreign exchange reserves and FX liquidity in the local banking system in Sri Lanka, one of the most discussed areas was the informal money transfer channels such as Hawala and Undiyal. So we welcome all of you to the today's session on effect of informal money transfer systems on the financial markets, the economy and the country. In any economy, in varying sizes, there exist informal money transfer channels, mainly for cross-border transactions. The extent of informal channels and the use of formal channels by money remittance depends on the characteristics of a particular economy and the financial market and the legitimacy of such transactions. Examples of these informal systems includes Hawala, Hundi, or Undiyal, or such other systems across the world, such as those systems given in the slide. These channels have been continuously used in moving the value of money from one place to another without the physical movement of funds since ancient times when there were no formal banking channels. Certain countries with informal money transfer channels, such as Germany, UK, US, pursue regulatory approaches in registration and licensing such service providers, along with imposing AML requirements. Dealers of these channels live in different countries and settlement of transactions occur completely based on trust. An agent in one country collects money from people who need to send money to another country, and the agent in that particular country settles those amounts to the intended recipients in the currency they desire. Accordingly, there is no physical cash movement across the borders. No financial institutions are involved in cross-border transactions, and no transactions are properly recorded under these channels. However, financial institutions may be involved in the event domestic fund transfers are required. This is how the informal transaction systems are being executed. These are through remittance codes from remitter to the beneficiary. Main users of these informal fund transfer systems are foreign workers remitting money for families in their native countries, traders paying funds for goods imported and receiving funds for goods exported, parents transferring funds for their children's foreign education, people who live in areas with less developed banking channels that provide remittance services, migrants without proper visa remitting funds, and illegitimate users such as money launderers and terrorist financiers. Features of these informal money transfer systems: accessible for remittance easily, affordable charges, anonymity assured, convenience to remitters and the beneficiaries, speediness, risk involved in these type of transactions, high possibility of losing all the hard-earned money. Sometimes these dealers are directly or indirectly involved in criminal activities such as fraud and drug trafficking to balance the books. So users may also be inquired by the authorities. Impact of financial markets, the economy, and the country via these informal money transfer methods. Impact on balance of payments and FX reserves. Workers' remittance have become a significant component in foreign inflows and the BOP in emerging economies like Sri Lanka. When workers remit foreign exchange through informal channels, such earnings are not reflected in the calculation of BOP. This is relevant to several other components reported in the balance of payments, such as merchandise trade. Accordingly, balance of payment statistics will not reflect the true position of the external sector of a country. Further, since these FX reserves of a country are accumulated through the transfer of funds via formal channels, these transfers will not help in building FX reserves of a country. In fact, it could deplete reserves due to the possible switch between formal and informal channels. Second issue, impact on financial intermediation, money supply, and monetary policy. The leakage of money from the banking system could constrain the availability of banking resources. It could also cause an increase in market interest rates when banks attempt to attract deposits by offering higher interest rates. And banks may also lose their market share as well. The direct effect on broad money on an economy is almost zero for these transactions. The negative impact on the banking sector and the development of a cash economy, which could create instability of demand for money, would limit financial intermediation and affect monetary transmission mechanisms, causing inefficiency in monetary policy. Third issue, impact on national security. These channels are forms of underground banking methods, which is considered a threat to the effectiveness of the fight against terrorist financing, since these sources of terrorist financing are channeled through such informal mechanisms. Another issue is lower tax income for the government. This incurs losses from direct taxes in the form of income taxes as well as indirect taxes and registration fees, service taxes, and etc. And it could happen via invoice undercoating for imports as well. Measures for mitigation of these illegal fund transfer methods. In India, these transactions are restricted by prohibiting the making of any payment to any person outside India without conditional approval from the Reserve Bank of India. Pakistan took steps towards the transformation of money changes to FX companies in which they were given a 2-year period to register and comply. In Sri Lanka, CBSA plans to pursue steps to implement an appropriate legal framework. These are the references used in this presentation. FATF, Central Bank of Sri Lanka Annual Report, and Finance and Development. Thanks for watching.